Once every 2 weeks, I'm presented with a different atmosphere at my office. The secretaries are pleased to see me, the associates seem more motivated, and even the manager himself seems a bit more cheerful. Now, if I can assure you of one thing, it is this. The unusual behavior exhibited by my colleagues on this special day has nothing to do with me. Rather, this wonderful day provides validation that the work they do is appreciated for the value it adds to the firm. Have you still not guessed what this day is? Well, if you guess payday, you're absolutely correct. A dividend paid to holders of a company's shares represents a part of the firm's after-tax profits, which the firm chooses to share with its owners, the shareholders. When it comes to deciding how to make use of a company's profits, there are generally 3 basic options available to the firm's board of directors. 1. Net profits can be reinvested into projects which the firm feels will be profitable, or 2, net profits can be held in cash within the corporation, or 3, net profits can be distributed to shareholders in the form of a dividend. Corporations that choose to distribute dividends to shareholders generally do so 4 times per year. Each company sets its own payout schedule and determines the dates on which the dividend payments will be made. Some companies may even pay a special one-time dividend every so often if they are in the position of holding excess cash with no immediate plans for deployment. To summarize, dividends are the portion of a firm's after-tax profits which they choose to distribute to shareholders in the form of cash. With that being said, why should an investor care about dividends, and where do they fall under the realm of total return? When an investor purchases a share in a company, their total return is derived from 2 components. 1, share price appreciation, and 2, the dividend income. Let us assume an investor purchases 10,000 shares of Company A at $10 per share. Company A pays a quarterly cash dividend of 5 cents per share, equating to an annual dividend yield of 2%. After 1 year, the investor revisits their portfolio to evaluate the performance. At this point, shares in Company A are trading at $13. Over the course of the year, what was the investor's total return? Remember, as previously mentioned, the investor's total return is derived from both share price appreciation and dividend income. Since the investor's 10,000 shares increased from $10 per share to $13 per share, their unrealized gain from share price appreciation would be $30,000. In addition, since the investor would receive 4 5-cent dividend payments for each of their 10,000 shares over the course of the year, their total return from dividends would be $2,000. When we compare the return generated from dividend income to the return derived from share price appreciation, investors must be aware of 2 notable differences. 1, dividend income is calculated independent of a company's share price. Therefore, in our previous example, even if Company A's share price had decreased to $8 at the end of the first year, the investor would still have received 4 $500 quarterly dividend payments, representing an annual dividend income of $2,000. Secondly, dividend income is paid in cash directly to the investor's account on the dividend payout date. However, a return generated from share price appreciation is not available in cash. Instead, it becomes locked in only when the investor decides to sell their shares. Until that time, the return is marked as unrealized to reflect the fact that it is likely to fluctuate as the company's share price increases or decreases. As a summary, the return generated by dividends is independent of share price fluctuations. On the other hand, the return generated from share price appreciation can be affected by short-term market fluctuations up until the point when the investor sells their shares and realizes their gain or loss. To further illustrate the concept of total return, we will use an example from our investment similar to that of dividend growth investing, namely real estate investing. If an investor purchases a rental property for $1 million today, charges their tenants $20,000 per year for rent, and after 15 years' time, the property's value appreciates to $1.4 million, what would the investor's total return be by the 15th year? Just like dividend growth investing, there are two components to the investor's total return. One, property value appreciation, and two, rental income. From the property appreciating in value, the investor would generate a $400,000 return. From the rental income, they would generate a $300,000 return. In total, the return would be $700,000, represented by the sum of both the return from property appreciation and the cash received from the rental income. Similarly, with dividend growth investing, the total return generated by investing in a company's stock is a sum of the return from share price appreciation and the return from dividend income. As we will see in future chapters, the dividend portion of the investment represents the most important component to wealth building and achieving financial success. The regular dividend payment date represents the investor's payday and should generate even more excitement than receiving a paycheck from work, as the investor did not have to earn the payment by physically going to work, but instead allowed their investment to work for them. We are about to put the last piece of the puzzle into place, the piece that will bring together what we have discussed thus far about dividends and the role they play in dividend growth investing. To explain this concept, let us return to our example of real estate investing. What if instead of charging the tenants $20,000 per year in rent, the investor would increase that charge by an additional 8% on an annual basis? For example, in year 2, the investor's rental income would be $21,600 as opposed to $20,000. By increasing the rent by 8% each year, the investor's return generated from rental income would be 81% higher than if rent remained static. In addition, in the event that the investor requires this rental income for everyday expenditures, they can view this rental property as an index pension, since they can rest assured knowing their income will increase at a rate faster than the rate of inflation year after year. We will continue to expand on this topic, which in my opinion is one of the most significant benefits of dividend growth investing, in Chapter 7. This real estate lesson truly illustrates dividend growth investing's secret weapon. Dividend income, together with share price appreciation, can present investors with a higher return than companies that do not pay a dividend. However, companies that continuously grow their dividends over time are the only ones that can truly maximize an investor's total return and create an index pension surpassing the rate of inflation. Unfortunately, far too many investors continue to focus their attention on picking companies that they, or the so-called financial experts, predict will generate a significant return from their share price appreciation alone. To make matters worse, these investors fail to distinguish between the factors that influence a company's share price in the short run and that in the long run, a failure that ultimately leads to poor investment decisions. Over the next 2 subsections, we will discuss the following 2 topics. A, why focusing on the long run is essential when employing a dividend growth investing approach. B, the positive correlation between dividend growth, earnings growth, and share price growth. Over the short run, a company's share price is influenced by factors outside of the company's control. A few of these factors include the following: geopolitical factors, government policies, the media, investor sentiment, and interest rates. Remember, even if a company is profitable, introducing new, innovative product lines and becoming a market leader in their industry, their share price is still susceptible to downward movements over the short run, since over the short run, share prices are not influenced by a company's profitability. In other words, over the short run, a company has no control over their share price. Since short-run share prices are susceptible to external forces outside of a company's control, what makes investors think that they can accurately predict short-run share prices? The reality is that attempting to predict share prices over a short period of time for any given company is truly an exercise in futility. With that being said, over the long run, the gap between a company's share price and their true fundamental share value closes. As you might imagine, the true fundamental value of any business, whether the business is publicly traded or held privately, is determined by its current and future level of profitability. Since companies have control over their level of profitability, over the long run, companies have control over the direction of their share price. As investors, if we are able to pinpoint companies that are likely to continue to be profitable, we can rest assured knowing their share price is bound to increase over the long run. With that being said, here comes the million-dollar question. How can we, as investors, identify companies that are likely to continue to be profitable? This question can be answered by viewing the interconnectivity between earnings, dividends, and share prices. If we know that a company's fundamental value is determined by their current and future level of earnings, we know that any future share price appreciation will be contingent on the company's ability to continuously increase their earnings over time. As mentioned earlier in this chapter, dividends are paid from after-tax dollars. For this reason, in order for a company to continuously increase their dividends paid to shareholders, they must continuously increase their earnings. Furthermore, if a company is able to continuously increase their earnings, their fundamental share value will increase since the company has increased profitability. Over time, the market will take notice of the discrepancy between the company's fundamental share value and their share price, causing the share price to increase in order to close the gap. At this point, the bottom line should be clear. Companies with a strong record of continuous dividend growth must continuously grow their earnings over time if they wish to maintain the standard of increasing their dividends paid to the shareholders. As a result, their share price is likely to move upwards over the long run. This interconnectivity between increasing corporate earnings and increasing dividends in order to increase share prices is as simple and basic as that, and has been for over 150 years. Now that you are aware of the positive correlation between earnings, dividends, and share prices, it should be quite obvious as to how investors can identify companies that are likely to continue to increase their earnings over time by simply seeking out companies with a strong record of consistent dividend growth rather than speculate blindly with companies that do not pay a dividend at all. Investors can identify companies that are likely to continue to increase their profitability. At this point, you should now have a clear understanding of the following concepts prior to carrying on with the remainder of this book. What is a dividend? The two components that make up stock market returns, share price appreciation, and dividend income. The power of dividend growth. Distinguishing between factors that influence share prices in the short run and long run. The positive correlation between dividends, earnings, and share prices. How investors can identify companies who are likely to continuously increase earnings by viewing their dividend track record. If you do not feel comfortable with these concepts, I encourage you to re-listen to this chapter once more prior to moving on to chapter 2. Before we conclude this chapter, I would like to leave you with a few must-know interesting facts on dividends. 1. The term dividend derives from the Latin term dividendum, or thing to be divided. In other words, companies divide their profits among shareholders through the form of dividends. Second point, companies have been paying dividends to shareholders for over 400 years. The first company to ever pay a dividend was the Dutch East India Company in the early 1600s. Third, historically, companies that pay dividends tend to be less volatile and have weathered down markets better than their non-dividend paying counterparts. Fourth, a stock's dividend yield is equal to the annual dividend payment divided by the stock's current share price. The dividend yield is expressed as a percentage and is interpreted by potential investors as the annual income they would receive for every dollar invested today. For example, if Company A's share price is $10 and they pay an annual dividend of $1 per share, the stock's current dividend yield is 10%. Furthermore, since the dividend yield is a function of the company's share price, one can expect for the dividend yield to change on a daily basis. Continuing from our last example, if Company A's share price were to increase to $15 and their annual dividend remains fixed at $1, their dividend yield would decrease to 6.66%. In other words, a potential investor would receive 6 cents in annual income for each $1 invested today. Fifth, dividends receive preferential tax treatment when compared to interest income. And lastly, when you own dividend growth companies, you own stakes in businesses who maintain a strong presence in their respective sectors. These tend to be profitable companies with strong business models and disciplined management.